Very good evening to all my dear students. We have come a long way. Today is the sixth day of our Economics for Finance revision. So today we'll be revising two different units. That is going to be Unit 3 and we are going to revise Unit 5. Unit 4 we are going to keep for the next class. So let us get to it without any further ado. These two are predominantly theory and predominantly fact-based kind of units, which means that there is very less for me to teach and more for you to remember. So you have to go through it accordingly. So whatever conceptual difficulties which might come along the way, I'm going to definitely answer that. So let us get to chapter 3, unit 3 of chapter 4. Now what happens here? In the first unit, what did we learn? We learned about how beneficial or what are the various advantages of international trade, right? It was predominantly that in the first unit. And if you look at the second unit, we did what? The control on the international trade by using what? Various instruments, right? Such as tariffs, non-tariff measures. We learned that in detail. And in the third unit now, we are going to discuss about trade negotiations. Now, when I say trade negotiations, what are we going to learn in this chapter is an international body, an international body which oversees the international trade, right? Why this kind of a body is necessary? Of course, just like any other trading scenario or business scenario, there is always a possibility that a conflict might arise or some disagreements might arise. Some kind of a crime can be committed in trade and business, and a lot of things need to be adjudged, right? So if a person from one country is dealing with the other, there is no responsibility of one person. For example, we being a citizen of India, there is no responsibility on us to comply with the laws and rules of some other country, and it's vice versa, right? They don't have to follow our rules and laws. So we need to have, so all these things which are done, these trades which are done, they are majorly on agreements, right? And if somebody violates this agreement, so what are we going to do? Whom are we going to call, right? So if your governments are not willing to sort that out for you, then there are some other bodies, right, which you can definitely go and mostly it is the government which represents this kind of issues which will come in international trade. Here there are some individual cases also. So basically, to resolve the conflict, to make sure that international trade flows in a smoother manner, we have international organization. Now the history of it is very interesting. That is in the year 1944, right? So when World Bank and IMF were formed, right? So these are called as Bretton Woods sisters, right? So what happened here? These two organizations were formed, and there was also a proposal to come up with something called as ITO, that is International Trade Organization. But it so happened that World Bank and IMF got their charter, but ITO did not go through because US Congress couldn't pass that resolution for US to join, and when US doesn't join, rest of the countries definitely won't join it, right? So that is why this the dream of ITO just remained as ITO for a long time possible. Now here, what are we going to learn? That from the beginning, right, whenever this international trade started, right, how it is being controlled, what are the various types of agreements that these countries are having with each other, and all these things we are going to learn. In that, the first and foremost and most important thing, right, what comes is, the regional trade agreements which were there even then and which are there even now, right? What do you mean by regional trade agreements? They are defined as a groupings of countries not necessarily belonging to the same geographical region. It's not necessary that your country's borders have to be touching for you to have a regional trade agreement. You can have a regional trade agreement, okay, with any of the country around the globe, right? Which are formed with the objective of reducing barriers to trade between the member countries. In other words, a regional trade agreement is a treaty between two or more governments that define the rules of trade for all the signatories, right? There could be minimum two signatories, of course, are required, And there are some regional trade agreement which encompasses several countries, 10, 15 countries, 20 countries. There are such agreements also, right? And let us learn, this is one important question for your examination purpose. What are the various types of regional trade agreement? First, we have unilateral trade agreement. What do you mean by unilateral? It is agreement under which an importing country offers trade incentives in order to encourage the exporting country to engage in international economic activities that will improve the exporting country's economy. So it is more like what? It is, the kind of a help or a kind of a international trade aid which comes in this kind of unilateral trade agreements, where the importing country offers a trade incentive, and which generally what say it supports the exporting country to export certain goods and services. There could be several reasons to it. One could be the scarcity of the product which is there in your home country. Also, there is a possibility that developed countries are willing to give boost, economic boost in the certain underdeveloped countries. That also could be the reason. That is about unilateral. It goes one way. Second, there is bilateral trade agreements. Bilateral agreements, these are the agreements which set rules for trade between two countries, two blocks, a block and a country. Okay, it can be two countries, it can be two blocks, or it can be a block and a country. For example, it could be India and US, or it could be Gulf countries with India, or it could be Gulf countries with the European Union, right? It could be a block, or it could be a country to country, or a block to country. These may be limited to a certain goods and services or certain types of market entry barriers. Next, we have regional preferential trade agreements. What do you mean by that? It is among a group of countries to reduce trade barriers on a reciprocal and preferential basis only to the members of that group. Okay. Now, it so happens that certain countries come up and form a group, and those countries help each other, or they have a preferential rate in which they charge their goods and services tax when they move from one country to another country. Next, we will learn these three things together, right? There is a trading block, there is a free trade area, and there is a custom union, right? What do you mean by a trading? What do you mean by, first let us learn what do you mean by a free trade area, right? So free trade area, what happens is, it is a group of countries which will have, a preferential rate between them, right? For example, there is, imagine that there is India, there is Afghanistan, and there is, let us say, China. Now, these three countries come together, okay, and they are going to have a free trade area among them. But whenever these individual member countries want to deal with the outsider, okay, they want to deal with the outsider country. Imagine that this bloc wants to, have a trade deal with, let us say, Japan. In that case, India will make their own arrangements with Japan, China will make their own arrangements with Japan, and Afghanistan will make their own arrangement with Japan. So this is called as a free trade area, where among the member countries there is a preferential rate, but when you're dealing with an outsider, right, you will have to do your distinct, okay, you are independent to do your decision. Okay, so what is a trading bloc? That comes. Trading bloc means it's a group of countries that have a free trade agreement between themselves and may apply a common external tariff to other countries. It may, okay, that word is very important. It may, which means that it may not also, right? They can deal with the outside country with the common, like what say, rules or common rate or common preferential treatment, or they might, do it independently also. It depends upon which is most beneficial to them, right? So the next one, there is a custom union. What do you mean by custom union? Custom union is not only about group of countries. They also have what? Certain a group of countries that eliminate all tariff on trade among themselves, but maintain a common external tariff on trade with countries outside the union, which means that how they deal with the outside countries other than the members of the bloc also is same, right? So that is called as a custom union over here. Next, let us go to common market. Now, what do you mean by common market? It means it deepens a custom union by providing for the free flow of output and the factors of production, labor, capital, and other productive resources by reducing and eliminating the internal tariffs on goods and creating a common set of external tariffs. So here, not only the your goods, right? Even your all the factors of production will move from one country to another country without any or let us say with the minimum restriction, right? That is called as a common market. And then there is economic and monetary union. Example is European Union, where even the currency is same, right? Europe uses euro as currency. So they have the foreign exchange operations which are done together. They have same currency which they use across their countries, right? So many member countries. So this is called as economic and monetary union. Now, first let us understand, right, what is the GATT, right? So everybody knows. I told you that this unit is majorly what it is. Uh, you know, uh, yeah. So it is majorly what it is majorly fact based. When I said it is fact based, something has happened some years back and something they have decided and some results have put out, right? So it is easily understandable to read. If you read it 5 times, 6 times, you will get it, so that you can put that in your exam answer sheet in the exams. For me, there is nothing more to teach what conceptually, right? So we are only like concentrating on where I can teach you conceptually so that, our time can be better utilized, right? If there is something that I can do and you can also do by reading it, then we will skip that particular topic because it is not important for us. But let me give a small introduction to what is general agreement on tariffs and trade. I told you that an international body is a must, right, for having any kind of smoother international trade. An international body governing the international trade is very important. But sadly, that did not happen when IMF and World Bank were chartered. This couldn't happen, right? But later they came up with something called as the General Agreement on Tariffs and Trade. Now see, there were a lot of definitely the initially only 23 countries came to this, right? They signed, only 23 countries signed, but at the end, almost at the end of this GATT, that is the beginning of World Trade Organization, almost 120 odd countries were already there in GATT. So although it is like just an agreement, right, and they are not called as member countries, they are called as signing parties, right? So whoever had signed this general agreement on tariffs and trade. So let us just give it a small read and we will understand it. Despite wide ranging benefits, a number of countries hinder the free flow of international trade by imposing trade barriers. It was felt necessary that all countries embark on cooperative economic relations for establishing the mutual self-interest. So when did General Agreement on Tariffs and Trade came into existence? It came into existence in 1948 and it was there for 47 years until 1994. But it was nothing but a multilateral instrument governing international trade or a provisional agreement. Okay. Once the WTO, even before WTO actually, it started losing its relevance. Okay, because it was just an agreement, it was not an international body per se. So why it was almost losing the relevance? Because it was almost obsolete to the fast evolving contemporary complex world trade scenario characterized by emerging globalization, right? So when general agreement on tariffs and trade was put up, it was definitely the globalization as a concept was not even known by most of the people, right? At that time only few of the countries were active on international trade, and definitely a lot of countries were protectionist countries, which mean to say that they were against international trade, right? And then what happened? A fast change happened during the 80s, where many of the countries, a lot of countries came into globalized scenario. In 90s even India entered, and with that GATT couldn't hold anymore, right? So GATT was not serving as a best means to control international trade, so it was becoming obsolete and it was losing its relevance. And then we have international investment, which had expanded substantially, right? Investments in the form of FDIs, in the form of FPIs, right? Those things started increasing, and because of that, again, there was a sheer need for a organization rather than just an agreement. Then intellectual property rights and trade in service were not covered by GATT. Of course, the IT revolution happened much later. The GATT came, so it did not cover a lot of aspects of even intellectual property rights, right? So with that, there was problem. And then world merchandise trade increased by leaps and bounds that was beyond its scope, right? So we never thought, nobody thought during the beginning of the GATT that the world trade will become what it has become today, right? And there was ambiguities, and there was the liberalization of agricultural trade was not successful because we know that agriculture was one of the major the contributor to the GDP of so many countries at that particular time. And if you say that you are going to liberalize that, people are not going to take it lightly, and because of that, GATT received a lot of backlash, right? And then there were inadequacies in institution structure and dispute settlement system, and that was also a problem, right? Dispute settlement system. If you take back that history, probably after your exams you can do some research on it. You can see that how so many judgments or so many resolutions taken by GATT were not followed by any of the countries who had signed those agreements. Forget about, let alone the people who have not signed, right? So there was a lot of problem with regard to dispute settlement system as well. And it was not a treaty, and therefore terms of GATT were binding only insofar as they are not incoherent with the nation's domestic rules. So when you compare nation's domestic rules and the GATT, that is an agreement, nation's domestic rules will be superseding the GATT terms, and with that it becomes very ineffective, right? And then came what? The Uruguay round. Everybody knows in Punta del Este, we had a Uruguay round of meet in 1986, and it was scheduled to be completed by 1990. And in 1993, the Uruguay round, the eighth and the most ambitious and largest ever round of multilateral trade negotiations, in which 123 countries were participated, was completed 7 years after 7 years of elaborate negotiations, and the World Trade Organization came into existence. We know that. And World Trade Organization has 6 key objectives. It is a very important question there. So to set and enforce rules for international trade, to provide forum for negotiating and monitoring international trade, to resolve trade disputes, to increase the transparency of decision-making processes, to cooperate with the other major international economic institutions involved in global economic management, such as IMF, World Bank, etc., and to help developing countries benefit fully from the global trading system. That also was one of the objective. So this can be a question for 4 marks in your examination. Next, there is an explanation of structure of WTO, which I'm not going to cover. So, where is its head office, where is its secretariat, who are the members, and how, what constitutes their, the basic structure, the organization structure of it. It is a one-time read, and, very less chance of questions being asked from the here. But, a 2-3 mark question in some time, I do not completely neglect that possibility as well, but you can read it and you can understand. So we'll go to the next important part, that is going to be the guiding principles of World Trade Organization. What are the guiding principles? Every international organization must have very broad, right? It should cover all the member countries and their needs, right? So it should have guiding principles which will benefit all, right? So those kind of guiding principles in one instance we have given over here, and then the explanation is given next. So I will directly go to the explanation. I will tell you what those things are, and we will move on. First one is, there is the trade without discrimination. When I say trade without discrimination, what do we mean? We learned about something called as the MFN tariff, right? While we are learning about the tariff measures, we learned about something called as the MFN tariff. That is what the member countries of WTO charge on each other, right? So it was also the Article 1 of GATT. So this principle states that any advantage, favor, privilege, or immunity granted to a contracting party to any product originating or destined to another country shall be extended immediately and unconditionally to the like product originating in or destined for the territories of all the other contracting parties, which means there is country A, there is country B, and you are importing, let us say, iron ore from both the countries, and you are charging X amount to country A, and you're charging X plus Y amount to country B, that is definitely discrimination, which is not allowed unless and until it comes under some other violations which the country B has done. So these are other factors remaining constant. You cannot discriminate among the member countries. That's what it says, and that's what even Article 1 of GATT said. If you see, you will understand that if you read the actual document, right, you will understand that most of the things which are taken by WTO were there in GATT as well. Okay, it became mostly obsolete because of the the sudden change in the world business scenario, rise in service sector and all that. Because of that, it lost its relevance, to be honest. But WTO covers all those factors as well. Next, we have National Treatment Principle, NTP. Okay, this is again taken from Article 3 of GATT, which requires that with respect to internal taxes, internal laws which are applied to imports, treatment not less favorable than the one which is accorded to like domestic products must be accorded to all the members. Okay, definitely, if you are providing some benefits to the domestic producers of the same product, right, you cannot again discriminate the treatment that you give to the member countries when you import from them, right? So in basically it is again a supplementary point to the first point, which is like, the discrimination should not be there. The national treatment, once you import it, they are your goods, right? You should treat it in par with the other domestic products, right? Once your tax is paid, right, they are your products which are, just like should to be treated like, the domestic products which are there, right? Next, we have freer trade. Freer trade means what? Lowering the trade barriers, basically. You lower the trade barriers, right? Open up your economies, open up your markets, right? Now, next is predictability. That is, investments will be encouraged only if the business environment is stable and predictable. The foreign companies, investors, and government should be confident that the trade barriers will not be raised arbitrarily, right? So whenever you say that I want international, business, or I want international investment in my country, you have to understand that your country has to be predictable, right? If the country is not predictable, that is, today we are saying that okay, we will support your investment, and we once we get billions and trillions of dollars, if we turn around and say that now we are changing all the rules, the person who has invested, who is sitting in the foreign country, will definitely start sweating, right? But especially when your investment is not in your hands, not in your country's hands, not in your government's hands, it is in somebody else's hands whom you cannot control, right? So that is going to be a problem. So your country's policies have to be predictable, they have to be stable. Okay, that's what it says. Next, we have principle of general prohibition of quantitative restrictions. One reason for this prohibition is that the quantitative restrictions are considered to have a greater protective effect than the tariff measures and more likely to distort the free flow of trade. Quantitative in the sense what? The on the size or on the number of items, right? If you have such kind of restrictions, they are more likely to distort the free flow of trade than having higher tariffs. Okay, that's what it is saying. Next, we have greater competitiveness. I don't have to explain this. Then we have tariffs as a legitimate measure for protection of domestic countries. So they see, although we have learned like how tariffs can be a barrier to trade, you cannot say that tariffs are completely bad, right? Sometimes to protect your domestic industries, yes, tariffs are the legitimate measure, right? But they should be supported by a very good reason, and they should be like done through negotiation. Okay, and it cannot be arbitrary and completely prohibitive. Okay. Next, we have transparency in decision making. The WTO insists that any decision by members in the sphere of the trade or in respect of matters affecting trade should be transparent and verifiable. Such changes in matters of trade or trade related rules have to be invariably and without a delay should be notified to all the trading partners, right? You cannot do like hide and operate through darkness, right? You have to be fair and square whenever you're dealing in international trade, and WTO is there to monitor and make sure every member country does that. Next, there is progressive liberalization. I don't have to tell you what liberalization means. Everybody knows that. Next, there is market access. That is, WTO aims to increase the world trade by enhancing the market. Right? You explore newer markets. Right? Explore the unexplored. Go and sell there. That is what world is doing to India right now. Right? For most of the world, India is an unexplored market. They are coming there, investing. They are making sure that they are actually many of them are surprised that how economy like India is thriving, right? Through the the pandemic and all these things happened, and our markets are had suffered a lot, and then we bounce back, right? A lot of things. Because of that, what will happen? People will get more confidence in investing in a particular economy, right? So WTO is one of the aim is to what it to increase world trade by enhancing the market access by converting all non-tariff barriers into tariffs which are subject to country specific limits. Okay, all these non-tariff barriers one day will very less non-tariff barriers will be there. Most of the barriers will be through tariffs only, and tariffs definitely can be reduced by negotiating with the other country who you're dealing with. Next, special privileges to less developed countries. I don't have to explain. Protection of health and environment. I already spoke about it during tariffs. And then a transparent, effective, and verifiable dispute settlement mechanism that is required, because it is not only the the problem. For example, if we in India, right, export something to Japan, let us say we exported iron and steel, right, and we exported iron and steel to Japan, and the matter or the conflict between India and Japan might not be only to be arisen from the trade between India and Japan, right? There could be something else. There could be some political scenario, or there could be some disagreement on some different vote which was done in UN, and India and Japan did not agree with each other, and because they did not agree, now they're having problems with the trade in which there was no problem before, and they want to solve one problem, right? And that problem can be taken to World Trade Organization, and the dispute settlement mechanism will definitely go through the problem, and they will tell who is right, who is wrong, and what can be done, and how to go about it, right? So these are what a certain the guiding principles, right, we call of WTO. And in shorter, this thing I have given in the notes, so you can look at that and you can revise whenever you're going through. And one question usually is possible from this segment. Okay, the guiding principle, one of the principle they might ask you what is the meaning of it, right? Then we will go ahead and learn something called as the overview of the WTO agreement. Now, see, there are a lot of agreements which are written under the guidance, or under the what to say, the suggestions, or under the supervision of WTO. There are a lot of agreements. Okay, for example, there is agreement on even agriculture, there is agreement on textiles, and there is agreement on various aspects where world trade is involved. Okay, so you might think that industry like, let us say, aircraft, domestic aircraft, right? Yeah, there is an agreement on domestic aircraft in WTO, right? So there are so many member countries which discuss among these about this particular topic with each other, and they do the trading. Okay, so why it is important? Because to get more clarity, right, and to have more beneficial trade, we need to have these individual modules or individual agreements based on sector to sector, or let us say industry to industry, right? So let us just go through some of the major provisions, and definitely it is written over here that thorough discussion of the features of each agreement is beyond the scope of this unit, of course, because a single agreement might take at least thousands of pages, which we cannot definitely go through for economics for finance, right? So we will just have a gist of it, what these things are, right? So the first one is agreement on agriculture, which aims to strengthening the GAWT disciplines and improving agricultural trade. It includes specific and binding commitments made by WTO member government in the three areas of market access, domestic support, and export subsidies. Then we have agreement on application of sanitary and phytosanitary measures. So it usually happens that sanitary and phytosanitary measures can be used as a tool to restrict trade also, right? So we need to have, see, that is what is written over here, to prevent from being used for arbitrary or unjustifiable discrimination, right? That kind of thing have to be avoided. Of course, every country has to have sanitary and phytosanitary measures. I told you how important it is in the previous revision lectures. But it cannot be used arbitrarily and without having a proper explanation, right? Just because you hate or you don't like to trade with one country, you can't just put these reasons and reject all international trade from that country, right? So that should not be possible. Then there is, as I told you, agreement on textiles and clothing, and there is agreement on technical barriers to trade. Then there is agreement on trade-related investment measures. Remember, all these things I have told you in non-tariff measures. So if somebody is looking at this class for the first time, you have to go to the previous video, as a revision day 5. In that, I have explained all these things in very much detail. And in the classroom scenario, forget we have taken like several minutes to explain each one of these things with the examples and whatnot, right? So here we can't do that detailed explanation. So we are going, fast. Now, and next is anti-dumping agreement. This also I've explained. Custom valuation agreement, right? I had mentioned about custom valuation. I told you that, there has to be reliable custom valuation, and it aims to harmonize the custom valuation system on international basis by eliminating arbitrary valuation system. For example, now imagine that you got a painting from USA, right, to India. You imported a painting. Now you paid, like, let us say $10 million for that painting. Okay, some really good painting, some old painting, antique painting. Now you brought it to India and you showed it to the custom authorities. See, you got this product. Now custom authorities want to tax ad valorem tax, that is on value. So when they ask what is the value, you say that the value is 10 million, but the custom officers are not willing to, listen to you. They say that no, the value is not 10 million, but you show, see, I have paid 10 million. They say that, see, all these documents can be prepared and whatever. This painting looks like it's very antique, and no way that it is coming just for 10 million, right? So what will the custom officer can do? In India or in any of the democratic countries, there are something called as custom valuation rules. You need to follow those rules and you have to find out. Okay. And if at all you give the power to the custom officer to say that the value of this painting is 100 million, right? What is that? Arbitrary valuation. That is, from where he is getting the value, he cannot explain, but he just say that, okay, value is this and you're supposed to pay this. That becomes what? A hindrance to trade, right? This kind of thing shouldn't happen, right? So there is a agreement in the WTO which only talks about custom valuation. See, here you can do, but here is the some things you can't do. Arbitrary things you can't do, and those kind of things. Next, there is agreement on pre-shipment inspection, right? So, of course, if you are importing something really valuable, right, from far off country, it is better to inspect the product before it is shipped than checking it in your location once it reaches, right? Because the transportation cost is huge. And what are these pre-shipment inspections, and how to facilitate them? Should you allow them or not? And all these things are written in the agreement, which is there for this purpose. And there is agreement of rules of origin. I have explained this yesterday. Agreement on import license procedures, agreement on subsidies and countervailing measures, agreement on safeguard duties and etc. General agreement on trade in services, agreement on trade related aspects of intellectual property rights, and we have the rules and procedures governing the settlement disputes, okay, which as to how to go about if you have a problem or if you have a conflict, or violation of an agreement with another country in trade. Then how do you go about the what is the procedure for going through the settlement and dispute resolution scheme of WTO, and all those things are written over here. So these are the general few of the agreements, and there is a trade policy review mechanism which is also there. It is nothing but they conduct a periodical review of the members' trade policies and practices conducted by the trade policy review body. In WTO, there is a body called as trade policy review body. What do? They just check, right, whether all the member countries are following proper trade policy and practices. They are not cheating each other, right? All these things and all, it checks, this body checks. Now, to what extent, to like, whether, you know, whether how effective this body is, that we cannot vouch for, right? But these kind of things are put in place to make sure that certain good can be done, right? And then there are, some trade agreements where, these are done between some countries. For example, agreement on trade in civil aircraft. Okay, so it has 32 signatories, which means all the member countries of WTO are not part of this. Okay, because they might not be relevant. Okay, it could be relevant to only those countries which trade in civil aircraft, right? So who manufacture and trade in it. So whoever is relevant will become the member of that. Then there is agreement on government procurement and all that, right? So these are some of the agreements which are entered into by WTO. Next, okay. Next, we will learn about the Doha round. What happened in Doha round? It is Doha Development Agenda, which is the ninth round since the Second World War, was officially launched in the WTO's fourth ministerial conference in Doha, Qatar, in November 2001. Right. So this is what I told you about. These are fact-based units where what happened so many years back. I'm just reiterating. Okay. So there is nothing that I can do which will add value to you. Even if you read the things, you will understand it. Okay. So I will skip this Doha round. Important for examination purpose. Okay, let me tell you is very upfront. Okay, there is no fixed questions which might only be asked in the examination. They can ask anything, right, from the book. Once they have given you the book, they can ask anything from it, right? So you have to know, but there are certain things you have to learn, right? Now these are the things you are not supposed to learn. You are supposed to know, right? You are supposed to read and know, right? So I will go to the next part. The next part is 25 years of the WTO achievement and its concerns. There has been spectacular growth in the world in trade of goods and services. Since 1995, the dollar value in the world trade has increased nearly fourfold, while the real volume of the world trade has expanded by 2.7 times. The average tariffs have almost halved from 10.5 to 6.4. Now, is the average tariff on any of the imported product is 6.4% during this period. The rise of global value chains have, if you want to know what is global value chain, just remember that I have told you new trade theory. I told you about network effect, right? So how a lot of companies are having existence in so many other countries, right? They are creating something called as value chain, right? And then what happened over the past 25 years, and how poverty elevation has happened in the years, and all those things are given here, where uh, see, a lot of poverty elevation has happened. But an important point here for you to know is now the World Bank's dollar 1.9 threshold for extreme poverty is there, right? There were so many people below it before, but now the rate of extreme poverty is less than 10%. Okay, it is the lowest ever it has ever reached. Okay. However, in the recent years, apprehension have been raised in respect of WTO and its ability to maintain and extend a system of liberal world trade. The major issues, okay, this becomes very important question. Okay, so mark that in your notes. The important question: what are the major issues? Okay. Now the progress of multilateral negotiations on trade liberalization is very slow, and the requirement of consensus among all members. See, this is the drawback not only of WTO; it is the drawback of all the international organizations in general. Right? You cannot get to forget about that. You cannot get if you are in a room of 50 people, you cannot get a consensus among them, and forget about 50 different countries coming from 50 different parts of the world with 50 different problems, right? You cannot make them sit and get a consensus among all of them, right? But they said the progress has been slow. Okay, just after giving them so many praises, okay, in the previous paragraph they told that okay, it has been slow, right? Then the complex network of regional agreements introduces uncertainties and murkiness in the global trade system. Okay, agreed. While multilateral efforts have been effectively reduced tariff on industrial goods, the achievement in liberalizing trade in agriculture, textile, and apparel and in other areas of international commerce has been negligible. You see, everything comes down to the the basic necessities there. In terms of basic necessities such as agricultural products and textiles, right? And forget about shelter. Shelter can't move from one country to another country. You need to have it in your own country. But agriculture and textiles, they are your food and your clothing. That is, two of the three basic necessities which we, called, right? And in these segments, the development in international trade is very difficult because people are very conscious. Okay, even today, right? Even countries like India, even countries like China, for that matter, right? When it comes to policies with regard to their agricultural products and textile products, they are very careful, right? So, and because of that, the tariffs and the restrictions which the countries have put on each other have not come down to a level into which we expected that to go down. Then the negotiations, such as the Doha development round, have run into problems and their definitive success is doubtful. Okay. Most countries, particularly developing countries, are dissatisfied with the WTO because, in practice, most of the promises of Uruguay round, to expand global trade has not materialized. Everybody is, not happy. Okay, that is okay. You can't make everybody happy, right? And then the developing countries have raised, certain number of concerns. Here, developing countries have raised these concerns. You know why? Because mostly these organizations are whether or not directly or indirectly controlled by the developed countries, and a lot of dissatisfaction is there among the developing countries that they are not getting enough share of the international trade and all that. So they have certain concerns which they are given here. The developing countries contend that the real expansion of the trade in the three key areas of agriculture, textiles, and services has been dismal. Protectionism and lack of willingness among developed countries to provide market access on multilateral basis has driven many developing countries to seek regional alternatives. They say that the developed countries are very restrictive and protectionist, and they are not allowing developing countries to develop. Okay, so they are going into regional alternatives. Okay, they are doing regional agreements like SARC, like ASEAN, right, and all these kinds of agreements. They are trying to stay away from the developed countries. And then the developing countries have raised number of issues in Doha agenda in respect of difficulties that they face in implementing the present agreements. And the north-south divide apparent in the WTO initial treats has meets have fueled an apprehension of the developing countries about the prospect of the trade expansion and the WTO regime. And all the biases which are there, they have been put very clearly over here. This can also be one of the question, okay, in the examination for 3 to 4 months. Okay, you read that once, that should be more than enough. Next, let us go to the other part of it, just mentioning of a summary of the agreements, the that were signed in the Uruguay round. Okay, I'm going to put that up over here. There's been some delay in screen sharing, but please do see it from the notes which we have provided in the free resources. So, what and all happened there? The agreement of establishing WTO, the general agreement on tariffs and trade, the Uruguay round, and the agreement on agriculture, agreement on sanitary and phytosanitary measures. Now, all these things we have already seen. Okay, so you just have to read this once, and you will have a better understanding of what these things. Okay, so just the name is given because it's not very important for examination. Whatever that I have told that it is important, they can definitely come in the examination. So this unit might contain one question in your exams. Okay, it could be of 3 to 4 months. So you should be able to answer that with ease, right? So this is it with regard to the third. This is with regard to the third unit of the fourth chapter. So if there are any doubts, this is the time to ask. I'll give 1 minute for Okay. So let us go to the next unit for our revision. That is going to be the unit 5 for of chapter 4. That is going to be the international capital movements and what is it and how uh, to study this. Let me cover that in the coming half an hour or 45 minutes. Now, first we will understand certain things. Okay, we will open a new page. In that, we will start learning about the unit 5, that is international capital movement. Now, what is international capital movements? Let me cover it now. First, understand we have all learned in the uh, foundation that there are 4 factors of production. There is land, there is labor, there is capital, and there is organization. Okay. Now, land definitely is not movable, not movable. Okay. Labor is already moving, right? People from India are going to so many other countries. Indeed, I doubt there is a country with no Indian population. Okay, they're already moving, right? And organization, the ideas, the entrepreneurs, definitely they're also already moving, right? And what left is capital. Okay? By capital, you mean money, right? So, how capital moves from one country to another country, that is what we are going to study in this particular unit. Now, why we are learning this? Because money is one of the major factor, okay, for any of the development activities or any of the industries to come up, any of the developing countries to become developed countries. Money is the most important thing. So we should be looking at, right? Even India looks for so many so much investments, so much foreign investment. Now, whatever money coming from a foreign country to India, we can say that it is foreign capital. Okay, it is a very very broad, okay, the way of looking at it. But if you look at the foreign capital and its types, okay, foreign capital and types, it can be broadly divided into 4 different. Okay. What are the 4 different types? First one is foreign aid. Okay, foreign aid and assistance. Okay, foreign aid and assistance. Now, what do you mean by foreign aid and assistance? These are usually given from one country to another country. Like, let us say a developed country gives this kind of aids to developing countries, okay, or assistance to developing countries. These are usually unilateral. That means one way, right? And probably they might have some possible positives, trade relations in the future and all that, right? And developed countries also can give, and some international organizations such as IMF, World Bank also can give to the developing and underdeveloped countries some kind of a transfer, right? And then this kind of aid when they give or this kind of assistance, this can be of 2 types. Right? It can be conditional or it can be unconditional. Okay. Conditional in the sense what? You will get this aid or assistance, but to dispose of that money, you need to follow particular ways. Okay. And unconditional means you can use it according to how you please. Okay. Especially when the countries like US, they give financial aid to countries like Pakistan, right? They're very careful, right? And they devise so many steps how to spend that money, because if this money goes into wrong hands in Pakistan, everybody knows what is going to happen, right? So here a lot of conditions are put. These are like conditional aids, we call them, right? And then there is unconditional, that is some countries get this kind of aid. Okay, for example, India gives assistance to Nepal, right? And usually the conditions are not attached. Okay, they say the general development. There are some assistance which is given in for particular projects. Okay, but usually it is given by. I can take the recent example. India gave so much assistance to Sri Lanka right now. They are going to economic turmoil, right? and they are definitely conditional, right? You have to make use of that money in particular ways and in particular means only, right? And you can take that example. That is the example for foreign aid or assistance. And second type there is foreign borrowing. Foreign borrowing. Now, foreign borrowing means what? Loaning of money from one country to another country or an international body to one country. Okay, it could be developed to underdeveloped country, or it could be IMF to some country which requires money. And then there is deposits from NRIs. Okay, now we know non-resident Indians. Everybody will have one or two relatives who are non-resident Indians, so I don't have to tell you that NRIs deposit money, they remit money, they create FDs in India, right? There are a lot of deposits which come from NRIs to India, and then there is foreign investment. This is where our entire unit is. Okay, foreign investment. All these things we don't have to study, right? That's just a part. But this part, foreign investment part, which comes in two different, types. That is FDI, foreign direct investment, and FPI, foreign portfolio investment. These become very important for our discussion in this particular revision. Now, first, let us learn what is FDI, right? Foreign direct investment. What is it? It is an act of acquisition or construction. It is an act of acquisition or construction of what? Of a physical asset. That is very important here. It is an acquisition or construction of what? Physical capital. Okay. In one country by the another. Okay. Very important. Imagine I'll give you an example of, let us say there is Germany. There is Germany and there is India. And in Germany, there is this company, Audi, right? And Audi is going to open their manufacturing plant in India, right? And here it's very important for you to note that this country which is making an investment is called as home country or source country, home country or source country, and the one which is getting the investment is called as the host country. Now, they have to create a physical capital, okay, in India, right? And there are three major things that is required. Okay, three major things that is required to make a particular investment categorized as FDI, right? First one is we call it as ownership. Second one is control, and third one is management. Okay? How much of ownership? They say 10%. The IMF and the OECD has told that it is 10% of minimum voting rights. But definitely that 10% is recommendatory from IMF, right? Each country can form its own policies, but India has still kept that at 10%. But simply ownership is not enough. You need to have control and you need to also have management. Okay, it should not be just for financial return purpose. If it's just for financial return purpose, it becomes FPI. We already know that. Then, what are the various components? Okay, components of FDI. Components of FDI go about like this. First, the equity investment. Equity investment. Okay, company like Audi coming and putting up money here and investing money, right? That is equity investment. Second, it will also include the reinvestment. Now imagine that Audi earned a profit of 50 crore rupees, right? And they did not take it back to Germany. They invested again in India. They opened another plant, right? Now this reinvestment is also called as FDI. And also there is a direct loan. That is, imagine that now Audi had one plant and they want to put another plant which is of higher capacity, but they don't have enough money. At that time, the holding company in Germany will give loan to the subsidiary company in India, right, of Audi, and that is called the direct loan. Even all these three things together are called as FDI. Okay, not only the equity investment, it includes even reinvestment. It includes even direct loans. Okay, this is a very important thing for you to know. Then Who can make FDI? Who can make FDI? Second question, right? It could be a company or a body corporate. Okay. And it can also be an individual also, right? There is no such restriction. In some sectors there are restrictions, but generally the restrictions are not there. Okay. Sector-wise restrictions might be there. Then, what are the various modes of FDI? Okay, how to do or how to go about putting up or investing in FDI in some country. One, they can go for creating a subsidiary, create a subsidiary in another country. Second, they can give a equity injection. Equity injection. What do you mean by equity injection? Right? A company is there in India, but it wants to go another mile forward, but they need a big investment and they got it from some other country, right? And imagine and remember that just having equity injection is not enough. After that, you need to have what? The control as well as the management of that entity as well. Then third one is taking controlling interest. Taking controlling interest, okay, and controlling interest. In a company in India, if you take, definitely you will have the management also, right? That is why usually people take controlling interest to control and manage the company, right? And then fourth mode is M&A, that is mergers and acquisition. Right? Merger and acquisition, what is the difference? Merger is when two companies merge. Acquisition happens when one company acquires another company, right? So the previous company will cease to exist once the company is acquired, right? So that is these are the four modes which are straightforward and can be understood properly. And there is a fifth and a sixth which you have to understand. That is called, first one is called as greenfield investment. Second one is called as brownfield investment. The simply put the difference. I have given very good notes on this. Okay, you can read that. I'll just clear your concept. Greenfield means what? It is a fresh start. Foreign company coming and starting afresh in India, right? They had nothing. They're starting from the scratch. And brownfield means what? Already something was there, and they're going to acquire that and build on it, right? So it is not a fresh start. This is in short what you have to understand. But in the examination, don't write fresh start, not fresh start at all. You write what is there in my notes. Okay. Next, let us learn about the types of FDI. Types of FDI. What are the various types? First one, there is horizontal FDI. FDI. Okay. What do you mean by horizontal FDI? It is acquiring same line of business. Okay. That is, I am a car company, and in the host country, I am going to acquire another car. Right? It's called as horizontal FDI. Right? Same line. Second, we have vertical FDI. What do you mean by vertical FDI? Vertical FDI means, imagine that I am a car company. And I am going to acquire a company which is into car distribution. Or I'm going to acquire a company which is into tire manufacturing. Okay, or it is into engine research. Okay, now these are called as what? Vertical FDIs. It could be what comes before my product, or it could be what comes after my product. So I'm going to acquire something related, either before me or beyond, right? So that is called as a vertical FDI. And then there is conglomerate. Conglomerate means entering into totally new business. Totally new business. Okay. So some company entering into totally new business in another country. And then there is a two-way FDI. Okay. What do I mean by two-way FDI? Where it works both ways, right? One country invests in another, and in turn, the host country invest back in the home country, right? Two-way FDI. Okay, that is next. Next, we'll learn something about FPI. Right? FPI, definitely what? Which is not FDI is definitely FPI, right? So, what is the intent of FPI? Let us learn that. Okay, here it is majorly what? Transfer of financial capital. The transfer of financial capital from one country to another, and the intention is only return. Okay, intention is only what? Return, which means that they are interested in what? Earning money. Are they interested in controlling the entity? No. Are they interested in managing the entity? No. Are they interested in even creating a physical asset? Whatever you do, I just give money, I want return, right? This is called as FPI. And then the time period of FPI is usually short. Okay, it is usually short. And FDI, it is a long term. Of course, you're creating a physical capital means you need to stay for longer time to take your money back, right? So this is with regard to FPI. And here there is an important question which I have to go through. I have given that in my notes. I told you what FDI is. I have told you what FPI is. So there is a next question which comes, that is difference between FDI and FPI. Now this becomes an important question. Okay, it's the important question for your exams. Okay, so please go through the notes for this particular part. And then we have a pertinent question which needs to be answered. That is, why FDI? Okay. Why FDI? Why should any country or why should any individual organization should do FDI? Okay. Points are many, so let us cover one by one. Right. First of all, for higher rate of return. Okay. In your country, the market could be saturated. In another country, the market could be just blooming. Right. So you need to make money. So you will go and you will make a higher rate of return there. Okay. Best example is Apple. Apple is so saturated in USA, right? In some of the other countries, and they're trying to milk the other countries which are not yet, the usually the people who consider this product to be luxury, right? Wherever. And then we have economies of scale, right? So being existent in so many countries will bring you economies of scale. You can buy certain raw materials for cheaper. You can get some factors of production for cheaper. Then there is control on production process. Companies which are greatly depending upon technological advancement and research, they don't just give away their technology. If they want to enter into a country, they will come themselves, right? And they will put up their own plant and their manufacturing unit so that their production process remains intact. And then to have control over patents, again, control over patents, similar point. And there is you can save time in transport, right? And other cost, like for example, I can tell about Apple only, right? So the mobile phones which are supplied in India, they're not assembled in California, right? They are done nearby countries like China, right? Taiwan and other countries. They assembled and manufactured everything over there, because the transportation cost, of course, to supply into Asia, right? They don't have to do it from US, right? They can do it from a country because they have a lot of manufacturing plants around Asian areas as well. Okay. Next, there is strategic sourcing of raw materials. Okay. And then there is, bypassing tariff. Okay. How do they bypass tariff? If importing is costly, right? So what do? They put up a plant only in that country, so that whatever is manufactured through that plant is definitely not you know import. It is domestic produce, and hence you can supply to that market, cater to their need, right? And better international relationships, etc., etc. There are several points, right? Why FDI has to be done in so many countries and all that. So those points will become important. So this also can be asked in your examination. So it's an important thing. Next, there is something called as host country determinants of FDI. Okay, host country determinants of FDI. Okay, which means that what are those things in your country, being a host country, are looking so attractive that people from other countries want to invest in your country? Like, what are those determinants, right? So the first one over there is market seeking FDI. Market seeking FDI. So everybody looking at India as a very growing market and they want to invest in India, right? And they want to make use of that growing economy, right? So these are first of all, let me put it under economic reasons. Okay, there are two determinants. One is economic, one is non-economic or other determinants. So first, let us discuss market seeking. That is, a growing market is a big eye catcher. Okay, for a lot of the people who invest. So if the market is growing faster, they will definitely invest. Then there is a resource or asset seeking FDI. Okay. This resource can be anything. It can be labor also, right? India is called as a young country, so people want, and India is filled with the the labor, okay, to provide. And some of the countries are there which are filled with raw materials, right? So they can source it, and there are FDIs which are concentrating on getting that from the other country. Hence, they go for FDI, right? That's very attractive. And there is efficiency seeking. Efficiency seeking FDI. So if you want to put up a entity in a country where the IT company can be produced and managed very effectively and with the very low cost, the country is India, because we have very skilled labor in IT, and the amount that you pay to the engineers over here is nothing compared to what they have to pay in countries like US and all, right? So here, efficiency seeking FDI is there. Okay? They will strike a balance between cost and benefit, of course, right? And they will come and invest in the countries which definitely would look attractive for them as an investment. And there are other factors. Okay, these are about economic, about money. There are other factors such as political, legal scenario. Okay, that's a very important thing, right? That the political stability and legal independence are the two things which any investor should look at, because tomorrow, if something happens in that country where you have invested, it is a legal system which will get you out of it, right? If the legal system is not, if the legal system is not efficient, then you should not really go for the investment in that country, because there is no guarantee that you will get justice, right? And you have to also see second one, that is what is business facilitation. Okay. Especially in countries like India, I will tell you what, right? So the investment seeking is done properly, but the administrative procedures which are there after the investment has come is very huge. Because if a country like US and Canada, they want to put up a plant in India, right? And after putting up the plant, there are so many compliances, so many laws and regulations which they have to comply, and they shouldn't be left blind. They have to be guided properly, right? They have to be provided facilities, right? And they have to be facilitated properly. They have to be mentored properly. And a lot of things, are if there is a lot of facilitation in a country, that looks like a very good opportunity for FDI. So these are the determinants, host country determinants of FDI. And then there are factors which will make a country not attractive for FDI. Right? There are factors which make country not attractive for FDI, such as first one, if there is lot of inflation, right? It looks very bad, right? And then FDI will not come into your country. And if you have unskilled labor only, right? Unskilled labor, that's very a turn off for FDI. And then there is bureaucracy and corruption. Okay, when I say bureaucracy, it's understood. Okay, the administrative procedures will be difficult, and corruption, if it is there, a lot of bribing needs to be done and all that. Like, it's very it's a disincentive for FDI. And also there is a fourth one, that such as a rigid legal process. Okay, this is also a turn off for FDI, right? So there are so many points that we learned about FDI. Now we have to go to the next part, that is going to be the advantages and disadvantages. So let us go back to my notes there. So we can revise from there, and I can just tell you few of the points, and I can tell you how to go about it. I've written so many points over here, right? And all the notes is given. You can go through the notes and you can actually understand. I have already explained to you so many ways in which uh, the benefits and the disadvantages of FDI can be understood. I have been discussing from the beginning itself, right? So let us go ahead and let us read a few of the points so that we can get a clarity on that. So what are the benefits? Entry of foreign enterprise usually fosters, right, the competition and generates a competitive environment. That is when the foreign companies come to India and they start competing with domestic industries, it fosters competition, and competition generates what? Competitive environment in which our technological improvement will happen, and people are compelled, okay, to get better at what they do, right? And then international capital allows countries to finance more investment that can be supported by domestic savings. And from the perspective of emerging and developing countries, FDI can accelerate growth and foster economic development and all that. Then we have discussed this. Competition for FDI among national governments has also helped to promote political and structural reforms, right? So when countries and investment comes from foreign countries, it's not only the investment comes, it's also the best practices which they follow, that also will come, right? And with that there are definitely there's going to be reforms in our country. And FDI not only creates direct employment opportunities but also through backward and forward linkages generate indirect employment opportunities. That is also very important. If at all there is a company which provides directly employment for 100 people, indirectly it might be producing employment for so many others, because to cater to the needs of this company there could be so many other companies which are working, right? So yeah, it is creating indirect employment opportunity also, right? Next, foreign direct investment also promote relatively higher wages for skilled jobs and all that. There are a lot of points. I have given around 15 points, which is easily understandable just by going through it. So you have to remember any 4, 5, 6. That is more than enough, right? The bigger questions for larger amount of mark will not be coming here. 4 marks, 6 marks is, I don't know whether it is a possibility, right? 4 mark questions will not require you to write 15 points, right? So you can write few of the points and you can get the marks. And there are potential problems associated with FDI. Okay, what are the potential problems? See, first one is FDIs are like concentrate on capital intensive methods for production, and they need to hire only relatively few workers, right? When the FDI comes, they come with technology, they come with machines. So if for a labor abundant country, it might not be a very good thing, because labor will become jobless, right? Unemployment might creep in and all that. That could be a challenge. Then the inherent tendency of FDI flows to move towards the regions and states which are well endowed in terms of natural resources. This is a very good claim actually, because this is what we have seen in many of the Gulf countries as well as countries like Venezuela. When they are very rich in natural resources, so all kinds of developing countries will clamp down on that country and try to extract as much as possible, right? So then those countries will become protectionist and their country will never improve and all that, right? So this is the inherent tendency of FDI. They are right in saying that. Then it is usually alleged that the inflow of foreign capital may cause the domestic governments to slow down its effort to generate more domestic savings, right? So if all the money is coming from the foreign country, what will our government do, right? Government will not stimulate any investment in India or savings in India, and they will just enjoy the tax revenue and just to facilitate the foreign companies, right? That is not why, that is not for which the government is elected for, right? They need to have their independent policies and they need to have a stronger domestic economy. Next, often the foreign firms may partly finance their domestic investment by borrowing funds in the host country's capital market, right? Already coming into India, but taking all the loans in India means it definitely will create more demand for money, with which interest rate will go out and go up. And with that, there will be crowding out effect. And how that happens, we have already discussed. Next, there are many points just like that. There are around 16 points which are given, and there is like a foreign direct investment in India, which is the next topic. Let us go to that, because the 16 points I told you, you go through these points, you are going to understand what it is. So I don't have to read each and every point out for you. That will waste your time as well as mine. These are very precious moments before the exam. So just go through these points, remember a few points, and try to write as accurately as possible in the examination. Let us go to the next aspect, that is FDI in India. FDI, of course, is a important monetary source for India's economic development and all those things said and done. Right? We have given some facts as to how much, FDI has come into India and how much FDI India has made. That is also given in the next, para. These two things can come as short note. Okay, what is foreign direct investment in India, and what are the foreign direct investments which are made by Indians in foreign countries. That also can form a question. So here also a short note is possible, right? And here there is an important question which you have to note down, that is where and all foreign investment is prohibited in India, right? Which are the sectors which are restricted, where foreign direct investment is not allowed. That becomes important question. So let us go through that. First one is lottery business, including government, private lottery, online lottery, etc. Gambling and betting, including casino. Chit fund nidhi companies. Trading in transferable development rights. Real estate business or construction of farmhouses. Manufacturing of cigars, cheroots, cigarillos, and cigarettes, of tobacco and tobacco substitutes, and activities sectors not open for private sector investment, that is atomic energy and railway operations other than permitted activities. Now, these are so many of the sectors where FDI is not allowed in India. So this can form a 4-mark very strong question over here, 4-mark question. Okay, so note that down, and it becomes important for you. So with that, we have finished the revision of the 5th unit also, right? So if there are any doubts with regard to the same, this is the time to ask. And in the next, class, we are going to cover the last unit, that is the 4th unit, which we have skipped for this particular class because of the size of that, unit. We will not be able to complete within 1.5 hours if so happens. So we have not covered it in this session. We will be covering it in the next class. So if you have any doubt, this is the time to put that up. If not, we will conclude the class. Great. So you can alternatively use the forums which are provided in Indigo Learn app, which is OneFin, and you can put up your questions, and we'll be glad to answer that. So let us meet in the next class. Study well.